Hello to all of you. Always a fantastic way to start a session with old Eddie. So we've got an exciting session tonight, and we got into a lot of detail with regards to this with our mastermind members. And so I really look forward to sharing with you some insights that I don't think a lot of people are aware of unless they actually have access to a family office themselves. And so without further ado, let's rock and roll and get straight into it. And this is all about unlocking the 6 pillars to wealth, the essential strategies that contribute to 85% of investment returns. So by the age of 65, these are the strategies which contribute to 85% of your total returns. Now, I like to always start with a question. And I always say to people, what would it mean to you in 12 months or less to be earning at least 5K passive income without any hassle or complexity? So chuck in the chat box to me. What would it mean to you? Think about it. Dream come true. I can relax. Liberating. Awesome. Thank you to those that put it in. Brett, freedom. How would you like a system which will statistically help you get there 5 times faster, safer, and simpler? So we like to talk about Jordan. He's a 55-year-old, worked very hard in his life. He wants to build a portfolio to ensure his wealth is preserved. He joined us because he wanted to build a globally diversified passive income of at least $5,000, $10,000, or even $25,000 a month, simply and safely. He wanted to diversify his investments between countries, currencies, and assets. He wanted to use his limited time to get effective results with predictability. He wanted to save decades of frustration and millions of dollars to get the right knowledge for him and his family. He wanted wealth protection, plan B, and a peace of mind. He wanted to be held accountable with an accountability partner to get results. He wanted to have a family office to help him manage all his financial affairs. He wanted to create generational wealth for his family. And he wanted to have a fully executed wealth plan and investor strategy sheet. And finally, he wanted results. So who here resonates with Jordan? Is this what you want? Is this what you need? What about Victoria, an entrepreneur in her 50s, devoted to family and business, aiming to build generational wealth? She's got a packed schedule, but she wanted a streamlined investment strategy that empowers her to make wise decisions, aligns with her goals, and frees up time for her grandchildren and children. She wants to understand the investment landscape so she feels empowered to make the right decisions for herself and her family. And she wants to focus on achieving financial freedom to cherish more moments with her loved ones. Again, who resonates with Victoria, or both? So we believe that this is all possible through living a life unlimited and through diversification 5.0. And we've just finished a challenge, literally last week. But if you want to go and sign up for our next challenge, it's an in-depth, it's where we go into it for 5 days. And our next challenge is on the 29th of July. So two and a half months from now. So you can go and sign up. And if you really want to go deeper into this, then this is the place that we've done it. And thanks, Shane, for putting it in. Then the next thing is the psychology of money. And what's so interesting here is that we're actually doing this literally tomorrow. And I meant to have this open. I had to restart my machine. So just give me 2 seconds. But what we're doing with our mastermind members is so exciting. So I don't know if you do or don't know what the Enneagram is. But in simple terms, I learned about the Enneagram about this time last year. And interestingly enough, the Enneagram is older than religion itself. It's over 5,000 years old. And there's 9 different profiles around yourself as an individual. And what's really interesting is it comes down to some of your core wounding as well as a child. Now, we all got core wounding. And what's fascinating to me is I've heard about the Enneagram before. It's one of the best profiling ones I've done. But what I've never met before is someone that could take the Enneagram and marry it to wealth. And so for me, what is so interesting is that when we were doing the Wealth Weekend with our mastermind members back in March, Anthony, who you're about to meet now, literally said, well, with our family office members, we also do the Enneagram for wealth, which is all about who they are as personalities, how they make decisions so that they can make better decisions for them and their families, what are their relationships within their families, and ultimately this ties through into generational wealth. And so this is the program that we're literally embarking on with the mastermind members starting tomorrow. So literally tomorrow morning with our mastermind members. So you got the psychology of wealth and the history of the Enneagram. You got understanding the Enneagram types of wealth, types in relation to wealth. You got money mindsets and belief. You got financial habits and patterns. You got legacy and family relationships with money, and you got money and partnerships. And then finally, Enneagram of wealth and smart investing. Once we finish this, so this is going to take us about 3 months with the mastermind members. We're then going to be pivoting into a gentleman called David, and he's going to be taking us through generational wealth and both social and conscious capital. So it's super, super exciting. And why this is all relevant is that the mastermind members are going to go really, really deep for the next 4 months in terms of this. From my understanding, this is one of the core foundational components that they do at a family office level. And our belief is that if the family office members are doing it, then we should be doing it as mastermind members. But what's really exciting is that Karen is going to be doing our next webinar, which is next Tuesday, on the psychology of money and running through the whole Enneagram of wealth, etc. At a higher level. It won't be at the same level the mastermind members are getting it at, but at least you'll be able to get access to it. So if you are interested in that, make a note in your diary. It's this time next Tuesday. And then at the end, we're going to run through a Q&A in terms of it. Now, Shane and Alex have built a wonderful system, and we call it our navigator. And you can literally go into our navigator, and if you're not quite sure what your next steps are, go into the navigator, and it'll actually help you to make the right decisions in terms of the next steps with the navigator. So it's really, really cool. And it actually helps you in terms of your own personalized journey. And Shane, thanks for putting the link in the chat box. Okay, I always teach people that the most important thing you need is 2 things: the right information and the right partners. A good example of the right information is that we basically sit down with the Calio team every single month. And so we'll be doing this again tomorrow morning. And just to give you an example, if I go through the Calio commentary, so I call it the TED Talks for Wealth on a monthly basis. Anthony will take us through what's happening in the different markets. What do we need to know? He'll take us through all the different asset classes. And then what he does is he takes us into the important things like inflation going up, interest rates, is it being cut? Where do we see the markets going? When Silicon Bank went bankrupt, when Iran attacked Israel, all of that type of stuff we run through. So it's a TED Talk to wealth. And why this is important is that if you go back to the presentation here, I always say to people, you've got to have the right information and you've got to have the right partners. Now, imagine every month, if you didn't have to go and read hundreds of pages or watch the news or, read loads of reports. Imagine if you could turn up once a month, for half an hour and literally get the most important information you need to know in terms of the financial markets globally. And that's exactly what we do with Anthony. Now, just to understand our partners and who they actually are, I wanted to share a quick video with you.
This doesn't change, guys. Asset allocation, and this is not all of the asset classes we work with, but asset allocation is going to account for 85% of your return and is the fundamental building blocks of asset management and a financial plan that's going to, produce income or anything. But Anthony's going to talk to this, and this will give you very specific kind of views around the returns, the averages, and where we think the value lies.
So, again, what Garth Wellman, so he's the CEO and co-founder of Calio Capital, which is a family office. Traditionally, family offices were only available to people with $250 million or more. And that's being democratized with the use of technology. And I'm going to do a quick video for you with Garth. But what he was saying was 85% of your long-term returns will come down to your portfolio construction. Now, I want to share a quick video with you because before I go into Anthony, and Anthony and Garth work very closely together, I want to share with you a video of Garth Wellman so that you understand what a family office actually is, because it's really, really important that you understand the power of a family office. You also understand why it is different from what you basically used to in terms of, you know, a typical financial planner, etc. So give me 2 seconds. I'm going to get this video up for you here. And here it is. Okay, enjoy learning what a family office is and why they're different from a financial advisor. So I'm super excited to be here with Garth Wellman, who's the co-founder and CEO of Callio Capital. Garth, I first met you 2012, 2013. You were helping one of the wealthiest clients that I'd ever met and helped invested. And I was fascinated by what you do. In fact, I'd never even heard of a family office until I met you. And I bet you that most of the people on this challenge have never even heard of a family office either. So can we just start with, what is a family office? And in your case, a multi-family office. What is it like? Because most people have never even heard of it.
Yeah, hi Scott. Yeah, great to have worked with you over the years. Yeah, I think Callio was actually one of the first people to coin the phrase multi-family office. A family office is typically a full financial management of a high net worth individual's affairs. Typically, a wealthy person would set up a family office to administer everything in-house. You would bring in, you know, legal attorneys, private equity, and construct a full suite of investment services, from, you know, offshore structuring to offshore legal advice. So we set up a family office to be an outsourced full financial services provider outside of the scope of just investment management. And that's what we brought to the table. And we realized that we wouldn't do that for a single family. And that was where we said we became a multi-family office. Our services were well outside of the scope of what a financial planner would do.
Well, talk to us a little bit about that, because most people, including me, only really understand a financial planner or / an investment bank. You know, maybe you've been invited to the private banking of investment banking, etc. What is the difference? And, you know, I'd love to ask you a question. I also want to give context from what I've experienced with all of our clients. But what is the difference from what people are used to what they get when they come through the Callio, you know, family office?
Oh, look, a financial planner is one service of probably 15 or 20 that a family office does. You know, a financial planner effectively looks at a person's wealth preservation or their wealth creation. He goes, how do I create more wealth if a person hasn't yet got sufficient wealth? And he goes to the typical listed market space. And if he works for an institution, he goes to his employer's institution and offers their products as a solution to create wealth. The more sophisticated financial planner is the one that's working with a high net worth and saying, well, here's how we can preserve wealth. And that preservation of wealth then comes in the form again of the same financial products, sometimes slightly more sophisticated, a little bit more on the offshore side. He's not often involved in the actual legal structuring, and that is just outsourced by the bank to alternative companies. So very little of what a sophisticated financial planner does really goes into him being involved in the taxation, the immigration, the international tax planning, you know, international business, corporate advisory, resolving tax issues, staying current. So I think a financial advisor is largely connected to creating wealth and using listed investments, and protecting wealth using listed investments, which is just one very small part of what a family office really does and is capable of doing with in-house services.
You know, it's so interesting because it reminds me just of a couple of clients, and a couple of people are going to meet these clients over the next couple of days, whether it's Cynthia or Abdul or Niels. But just the kind of the context I get from a bunch of people is, firstly, they were used to having lots of things all over the place. In fact, quite a lot of chaos and hassle. And the beauty that they love is that they can bring it all under one roof and actually have everything looked at. So whether they own a house in England or a house in America, for the first time ever, actually consolidate everything and have a sort of one plan, not this disparate plan all over the place. with multiple advisors. So that's the first thing. The second thing that I found really interesting, and Derek, who's actually a farmer, came up to meet with the Calio team face to face, and his words were phenomenal. And I always laugh at that, because why he said phenomenal, he said, I spent my whole life trying to find someone that I could, literally go to with financial advice, but with a holistic approach, not just stick me in the box. I'm just like, this is a product that everyone else is selling. And actually someone that could sit and understand me, my family, my needs, my wants, and ultimately come up with a bespoke solution. I mean, they're just two examples of many, many people that you've helped. But I like to sort of give people a little bit of context of why it's different. Just because we're used to a box of chocolates doesn't mean that there's actually not a much better solution out there in terms of it. So it sort of brings me on to the last question that I would have for you. And I know that Anthony will go into all the substance of how it all works, so people get the substance now. But what I wanted to understand from you was the feedback I get from a lot of people when they meet with you, they meet with Anthony, they come along to the mastermind, they learn and listen, and they go, but it sounds too good to be true. If you're working with some of the wealthiest families, around the world, why would you work with me? What's the reason for that? Why are you even here, helping me on this presentation?
Yeah, Scott, I've said it before. You can build scalable businesses, and I'm both a financial person and an entrepreneur. But what I started picking up is I don't think good advice should be the domain of just the super wealthy. Okay. And one of the greatest problems the world faces is wealth disparity. Where 99% of the wealth is held in 1% of the world's population hands. And we know that's one of the biggest problems that has to change. But the same with advice. The wealthier you are, the higher the quality of the advice, the more access you have to deals, the more access you have to create more wealth. So, in our universe, we want to create opportunities for a much broader, much more scalable suite of wealth and investors, for example. So I really want to see people that are hungry to learn, to create wealth, and to generate, economies like in a country like South Africa, where economics and business and wealth creation is so important right now. So for me, I'm looking at this and I'm saying, if we can teach the secrets of that 1% to 25, 30% more people, we create a much more sustainable world and a much more sustainable economy. So, yeah, I think that's where, where you and I have worked really well together is to create scalable but high-end information being accessible to other people rather than just the 1%. Yeah. And also, with the 65 clients we have, 70 clients, I mean, it grows all the time, I haven't counted, families that we have, so much opportunity exists within that for us to, to spread that opportunity and create a real symbiotic environment for wealth creation and transfer of knowledge.
Well, look, I mean, just from my side, I'm deeply grateful. We've been on this journey now for the best part of 18 months in terms of the actual mastermind and everything. Anthony turns up every month and teaches us, Selwyn and, so many of your team members have added so much value. And my learning, and I think I know quite a lot, but I realized I barely knew what I didn't know, so it's been phenomenal, this growth. And one of the things that I appreciate most is when I find, people that join the mastermind, they seem to have it all. They seem to know everything already. And then they come and meet you and they just have their minds blown of like what's possible. So I deeply appreciate the partnership. I deeply appreciate what you just said in terms of people getting access to it. And I look forward to others learning about what a family office is and, more importantly, how it can impact in their lives. So just a huge amount of gratitude to you and your team. Thank you for sharing it with others.
Oh, wonderful, Scott. Thank you for that. And yeah, it's been a great journey, and it's always so rewarding to hear compliments from your clients. And yeah, long may we continue to, teach and grow people.
Awesome, guys. Thanks so much, mate. Cheers.
Cheers. Thank you.
So did that make sense to you? Are you better equipped now to understand what a family office is and the importance of a family office? Now, with that understanding, with that substance, now I want to go deeper. So a couple of things that are important here. One is that we asked, so Alex and I actually sat with Anthony and we said, listen, you talk about portfolio construction, you talk about how at the age of 65, it's going to account for 85% of your total return. But what and how do you actually do it? Again, the English sort of makes sense, but how do you actually go and do it? And he came up with effectively the 6 pillars of wealth that they implement for their family office with each one of their clients. Now, we went away for a weekend with our mastermind members in March, and we spent an entire weekend literally just going through these 6 pillars. So taking each one of these pillars and discussing them for 2 to 3 hours at a time. But what I wanted to do was to share with you these 6 pillars so that you've got a better understanding of kind of the core 6 pillars to this whole portfolio construction. And just by the way, chuck it in the chat box if this is something new to you in terms of a family office, how these 6 pillars work, because this becomes really, really critical. And, again, if you've heard this before, I mean, I've heard Anthony now do this presentation a couple of times because we've done it for our mastermind. We've been away for the weekend. And every single time I hear him go through the fundamentals, I realize there's a whole bunch that I didn't understand or certainly wasn't implementing. And again, my big belief in life is you might know something, but unless you're doing it, you don't know it. So without further ado, over to Anthony. So just to introduce you quickly, Anthony works with Calio. They manage 60 families. They've got about $600 million under management. And the reason I love working with Anthony and the team is that if you're helping 60 of the wealthiest families in the world, you're getting access to the best information, the best advice, and ultimately, you're passing that on to those 60 families. And what I love as part of our mastermind is you then share that with the rest of us participants and help. And, it reminds me of a little story. Derek, who's a farmer, and he's been sort of with us for the best part of about a year. And Anthony and him met last Friday or 2 Fridays ago. And he phoned me, Anthony, and I think I've told you this. He literally phoned me up and said, that was phenomenal. Those were his exact words. I'm not exaggerating. And the reason being, he said, I've been looking for years, he went on to say, like decades, to find someone who could actually help me with investment advice, again, is registered legal to be able to do that, and just help me look at everything and be able to make the right decisions. And and that's from someone that I've worked with for a year, and he couldn't have raved more about you. So without further ado, I want to hand over to you. You're going to share with us literally what is portfolio construction, how do people do it, what do you advise the wealthiest people to do, and how can we copy?
Excellent. Thank you, Scott, and thank you, Derek. I agree. It was a very powerful meeting in the limited time that we had available. It was very good. All right. So as Scott, as you mentioned today, we're going to dive into portfolio construction and just essentially the fundamentals of portfolio construction, which get 85% of your returns. We'll touch on asset allocation and things like that within the presentation, but ultimately we're going to aim to cover 6 main topics. The first being one's time horizon, the second being one's risk tolerance, the third being asset allocation, the fourth being diversification, the fifth being your personal outcomes or goals that you want to kind of associate or attach to the money that you're looking to invest, as well as the kind of closing one of monitoring, measuring, and rebalancing the changes that you've made to your portfolio. So the first topic, time horizon, probably one of the more important topics of the bunch. We typically find if this is thrown out, then you don't really have an accurate roadmap or something to use to guide you throughout the whole process. And really, it's all about understanding the current situation relative to where you want to be. How we do that is a thing called asset liability modeling. And essentially that looks at your assets minus any liabilities as your kind of current asset base. And then it looks to kind of plot and understand how you view those investments growing, as well as any potential liabilities that you'll need to withdraw from those assets in the future, right? And then it's about understanding that ALM, which I'm going to dive into a bit more detail now. And then it's about defining the parameters of those of that ALM, because obviously the parameters they can make a big impact on the ALM. Now, I always kind of say this to people when I'm working with them through something like this. This is not a This is not the silver bullet. It's not the holy grail. It's not to say that everything's going to go perfectly to plan. As we know, investments can be volatile. They can have good years, they can have bad years. But ultimately, if we start to get an idea of the roadmap and where we want to go, we typically find that we're in a far better situation than just kind of freestyling it as we go along and just trying to make things up as we go. So diving into the parameters of this ALM, I've just done a kind of brief example here, just using some very random numbers, but I think it will help get the point across. So what we look to understand is the age of the client or the age of the person. In this example, we've got Mr. X, who's age 45. The plan or the goal is to retire at age 65. That's quite a traditional retirement age here in South Africa. Again, ultimately, this number can change, can go down to 55, 50. It all depends on the scenario and the parameters that you throw at it. What we then do is we look to protect the portfolio for a number of years. In this case, we use 35 years, which essentially, if you take the 35 plus the 65 year, you're aiming to provide a scenario where you're protecting capital, or your capital is sustaining you up until age 100, which I think we can all agree, although modern medicine is presenting its kind of ability to make people live longer, but I think age 100 is a pretty fair number. If there's any excess, that we typically view that as the kind of legacy aspect of the portfolio, or an inheritance for kids and things like that. We've got our years of saving, which is an important number. That's at 20. That's the difference between your retirement age and your current age. So that's assuming that one is still working, they're still running a business, they're still employed, whatever it might be, and they're able to contribute to the portfolio. Right. Current income, we said Mr. X earns R1 million a year. It's not overly important, that number. The more important number is how much of that is one saving or contributing to the portfolio, which I'll get to shortly. Then we make some assumptions, right? We assume inflation.
Just quickly, Anthony, one thing I just want to say is we've got people from all over the world that are joining us. So you're just using a particular country or a currency, but it doesn't matter. It's more the principles you're teaching.
100%, Scott. Switch that R for a dollar sign or a euro sign, whatever it might be. It's all relevant, because your expenses that I'll get to now will then be based on that amount. So it will all be relative. All right. So then we look at some of the assumptions. We assume inflation at 4% again. That's pretty geared to the South African market. You can alter that based on where you live and your inflation assumptions. We look at a return pre-retirement and a return post-retirement. We put a pre-retirement return on this capital of 10% and a post-retirement return of 8%. The reason why you see that taper off a bit into retirement is that typically when we build these portfolios, when we know that there's some time to go until retirement, we're able to be a little bit more aggressive on that capital and target higher returns that traditionally come with higher levels of volatility. And then we start to taper that off into a more risk-adverse portfolio on retirement. And the reason for that is when you make drawdowns from your portfolio, you don't want to get yourself into a scenario where you've got very risky underlying investments and you dependent on this capital, which would force you in a downward market to make withdrawals from a lower capital base. So we taper that off, because the risk profile naturally tapers off as the client gets older. All right, moving to the right hand side. We then look at our retirement income, which is also a very important number. So the retirement income assumes that Mr. X would like to kind of keep up with his current income, and when he retires, he would like to withdraw an annual amount of R1 million from this portfolio. So in other words, that's what he feels he needs to live off for the year, right? That's an annual income payment. Again, this is highly dependent on each person's current scenario or different scenario, but we've assumed that for now. We ignore the numbers in the gray shaded area, just moving down onto the savings habits. So this assumes that Mr. X is making 240,000 Rand contributions to the portfolio throughout his years of saving, right? Which again is the amount of time between his current age and his retirement age. So he's contributing around 20,000 Rand a month to the portfolio. And then the current savings balance is your current assets, your current capital, your current investments, less any liabilities. So we typically include all investments in there. We do include houses. It's obviously quite an important one. It's a difficult assumption because one needs to apply some kind of growth rate to the house. And this assumes if you take a house or fixed property or things like that into account here, you'll need to be quite confident that you can achieve a return of around 10% based off our pre-retirement assumption. But in a nutshell, that amount is your current investments or your current capital, less any liabilities. Now, when we jump to the next slide, we just kind of break down and we see what this looks like over time, and we kind of start to understand the compounding effect on capital, as well as the effect of making contributions and what that looks like. So if you can see my cursor here, which I'm hoping you can, you'll see in the balance column, we start with our capital amount of 3 million, and that is growing each year by 10% based off our pre-retirement assumption, right? We've got a contribution column, and that is starting off from the 240,000, but importantly, that's growing by inflation of 4% each year. So it's making the assumption that you're going to be able to contribute slightly more each year leading up to retirement, right? Whether that's via investments or things like that, or whether that's via salary increases or taking more money out the company, whatever it might be, the assumption is that that number is growing by inflation. And the salary, which is not overly relevant now, but you'll see that kick in shortly within the withdrawal column. But again, just understanding what that compounding effect of inflation does to one's salary, right? So there's an assumption there that you're going to have to increase your withdrawals based on inflation, so that you can have the same purchasing power that you do now in 20 years time when you become reliant on the withdrawals from the portfolio. So jumping a screen ahead, you can see we've been running the age column on the left hand side, but now we're essentially at age 65. Mr. X is retiring and he needs to start making withdrawals on this portfolio to sustain himself. Right, you can see the capital here has grown up to 39 million. It was untouched. We weren't withdrawing from it. We were achieving 10% a year and we were making contributions. So you can see that compound effect really taking place. But importantly, you can see the withdrawal now as we set it at 1 million. Mr. X only needed 1 million Rand, but now it's at 2.1. And the reason for that, again, is to assume that these withdrawals need to increase by inflation each year so that your purchasing power remains the same. So you can start to see how the effects of that increase on the withdrawal, even though we've got a capital base that's grown quite nicely, you can see here around year 33, 34, 35, or age 77, 78, 79, you can start to see the capital value starts to peak and it starts to taper off because the growth is no longer outweighing the steep increase in withdrawals, which is naturally going to happen. It's not the end of the world, but it's just something to keep in the back of your mind, that there will become a lot of pressure on the portfolio based off inflation and the amounts of money that you need to sustain yourself each year. And then in this scenario, we're getting to age 92, and you can see here the capital starts to become depleted throughout kind of 91 and a half years of age, or 48, 47 years from when we did this at the beginning. So this is just really just to give you guys an understanding of how these things work. Like I said, it's not set in stone, return numbers change, but ultimately this is guiding a lot of the decision making around the portfolio construction, this ALM, because we know roughly what we need to target with the different amounts of capital, right? We can't be sitting on 3 million. I'm just going to go to the thing. We can't be sitting on 3 million and targeting a 6% return initially on the capital, because then you're going to have a scenario where this capital runs out far quicker. So it just kind of sets the scene for what you need to be looking at, what asset classes you need to be looking at to deliver those kind of returns. All right, moving on to point 2. Here we look at the risk tolerance, and this is largely driven by one's time horizon. We view market cycles as typically 5 to 7 years. We start to get excited about equity market opportunities and things like that if the investor has a time horizon of around 7 years, because it means that we can sit out a market cycle, and we can be unimpacted by the volatility or the up and down market movements in between that cycle. So they become largely irrelevant if your investment horizon is longer than that, because you understand that you're not at risk. You don't need to make any withdrawals in that period. And if you just look here at the bottom left on this chart, ultimately what you can see there is you can see it going from, the chart starts on the bottom left and it ends at the bottom right, but it goes up and down in between, right? And that's typically what we expect out of equity markets. We expect volatility, but our overall trend over that period typically trends upwards, and that's what we're looking to achieve in these portfolios. If an investor has a market or a time horizon of let's say 3 to 5 years or 2 to 3 years, something a lot shorter than that, you're typically going to be looking at other asset classes to try and achieve those goals, because you could find yourself at the bottom or at the trough of a market cycle, and then you could potentially be in a position where you're losing capital. So you don't want to plan around that, and you don't want to withdraw during times of stress. You want to at least have a market cycle fully play out. And the last point there is I say that personal goals play a large role in determining the levels of risks one can take. And really that's quite straightforward. If you're looking to buy a house or you're looking to buy a car in a year or two's time, you're not going to take all of that capital and put it into equity markets for the reasons I just highlighted above. You're going to look at something a lot more risk-free, a lot more stable, a lot less volatile, versus if you're saving for retirement and you've got 20, 25, 30 years to go. Then you can stomach that volatility. You can take on that additional risk to achieve that additional return, and you can see out those market cycles. And again, just on the bottom right, a fairly obvious chart that's sometimes overlooked. That's really just showing you that the higher the risk you take, typically the higher the return one can achieve. So one needs to be comfortable in their understanding around that. You're never going to get a scenario where you're taking no risk but making massive returns. And again, this obviously feeds back into the ALM, because the ALM has guided us as to what we need to achieve over the different time periods of one's life. So we know kind of what we're looking for and what we're going to build that portfolio around. Topic number 3 is the asset allocation. Again, this is largely driven by the parameters of the ALM. It's also dependent on the time horizon of the investor. And again, it can be influenced by one's personal goals. So in terms of the ALM, what I've done here is I've shown a little screenshot or a little chart just to give you an idea of where returns are at and where relative to risk. And you can see here the first line item is a very vanilla MSCI World ETF. That's an exchange traded fund that tracks developed markets, so US and Europe. And that over the last 5 years, ending 31st of August this year, has achieved an annualized return in US dollars of 10.31%, right? At a risk or a standard deviation of just shy of 16. Now, that obviously makes no sense by itself, but when you start to look at it against the second line item, which is the global bond market, an average of the global bond market, and the last line item, which is US cash at the moment, you can get a sense of the returns, right? The returns in the bond market haven't been great. Traditionally, that probably sits closer to 2, 3, 4%. But what's more important here is to understand the significant drop-off in risk. So you're going from pure equity at around 16, you're going to bonds at around 6 odd, and you're going to cash at pretty much 0. So that just gives you an idea of where you need to kind of look for your returns. Obviously, there's alternatives, as I show on the right there, and there's private equity and things like that. But traditionally speaking, this gives you a good idea or understanding as to where the risk lies, and what kind of returns you're going to achieve, which again speaks to the asset liability modeling and how those portfolios are constructed around those specific parameters. Alrighty, moving on. Number 4, the fourth topic we look at is diversification. We look at diversifying holdings across different asset classes and sub-asset classes. Fairly straightforward. I've given a chart on this on the bottom left, but you can see at the top our 5 main asset classes being equities, bonds, alternatives, commodities, and cash equivalents. But we note that there's a lot of underlying sub-asset classes under each of those asset classes. So there's a lot of areas where one can kind of find value or find opportunity or find investments that are able to tick the specific boxes that they as an individual need, right? So you can see, I'm not going to go through all of them, but you can see kind of the broad brushstrokes of the sub-asset classes. So we typically look to diversify amongst a lot of those. Again, a lot of that's based off research and macroeconomics at the time, but we try and have quite a broad exposure there to aid in diversification. The second point is that there's an ability to add alpha via manager selection and style allocation, right? Alpha is outperformance. Alpha measures outperformance relative to a respective benchmark. So if you have an active manager that is using the S&P 500 as his benchmark, if he's able to outperform the S&P 500, that difference in outperformance is categorized as alpha. So what we're saying is that even though you might see indexes like the MSCI World in our previous chart achieve a return of 10.3% annualized over 5 years, with the help of an investment professional, you can start to identify fund managers who may have beaten that benchmark over time and generated alpha, which obviously aids in the asset liability modeling and generating returns that are higher than that of indexes and higher of that than what the individual needs to achieve to make his ALM parameters hold true. Which I'll show you an example of that on the next slide. The next point is using active managers to shift between different styles of investing. Again, there's a lot of highly skilled individuals out there who have done this for many years, who have the ability to navigate between those different sub-asset classes as and when the value starts to emerge in all of them, which is quite important. And again, I'll show you an example of that. A very interesting chart on the right. This is a chart that I love, that really talks to A, diversification, and B, the inclusion of private equity or alternatives in an investment portfolio. I said it last time, but don't look at this as private equity. I would kind of include all alternatives in this section here. So real estate, private equity, hedge funds, and infrastructure. But in a nutshell, what we've got here on the bottom axis is our standard deviation or our risk, and on the left we've got our annualized return, right? So you can see the risk starts to pick up and the return starts to pick up. But if we start at the bottom right as opposed to top left, you can see here that if you have a portfolio that includes 30% bonds and 70% stocks, you're essentially targeting a return around 8.5% odd, with the highest levels of volatility. So this is not efficient. It's not maximized, right? Because you can do a hell of a lot better. As soon as we start to...
Sorry to butt in, Anthony, but I shared this yesterday, and I acknowledge I stole it from you. But the point being is that's where the majority of people money is. If you just take the standard portfolio, you've been put in a box, like that's what everyone else is. That's pretty much where I don't know what percentage is, but 90% plus of people are sitting.
Yeah, quite right. So as we kind of move from bottom right to top left, you can see each kind of pie chart includes more and more private equity. So it goes from 5 to 10 to 15 to 20, with the point being that you're actually, the more private equity or alternatives that you're adding to a portfolio, you're lowering your risk and you're increasing your annualized return. Right, so this for us becomes a kind of efficient or a maximized portfolio when you're sitting with an allocation to alternatives of around 20%. We internally we'll go a little bit higher than that, depending on the client's specific interest and B, their experience within the alternative and private equity space. So a lot of entrepreneurs are very comfortable going to higher alternative weightings because they understand private business. They've typically run one or run and sold one, so they're comfortable in that space, in which case we would potentially push that to a max of around 30%, but for the better part of it, 20% is that kind of sweet spot, obviously diversified by your primary allocation to equity markets, as well as an allocation to bond markets. Again, those two numbers, the 30 and the 50, are not set in stone. That's traditionally kind of juggled between the two based off fundamentals and the macroeconomics at the time. Like I said, bonds have not been the best place to hide for the last year or so, especially in long dated, longer duration bonds. So you would have been far better off in the stock market. But yeah, that's something that we weight accordingly. But I think the kind of key takeaway here is that allocation to alternatives and how it can diversify, decrease risk, as well as increase return. Moving to the next slide where I look at those, just two examples of active managers that have the two biggest indexes in the world as their benchmark. The first index being the Vanguard S&P 500. That's an ETF, but it essentially tracks the S&P 500 ETF. And we can see here that there's an active manager called Center American in our example. He's achieved a return over 5 years, annualized of 13% relative to the S&P 500's return of 11%. Interestingly enough, his standard deviation is lower than that of the S&P 500, meaning that he has generated a higher return at lower levels of risk. And that leads to the positive alpha number, which I spoke about earlier, being a measure of outperformance, as well as a relative return of essentially 21.82%, which is an important number because it shows it looks like on paper, it looks like a 2% annualized outperformance, but on a cumulative basis, that number starts to get a hell of a lot more attractive at 21.82, relative to an already well-performing benchmark or index. So again, just an example of how one can find guys that can do even better than their respective benchmark or index. And then just another...
Anthony, someone asked about SD, standard deviation. In simple terms, my understanding, if you look at return equals, the return you're going to make on your investment, and standard deviation equals risk. So what that means is, like in Bitcoin, you might have awesome returns, but you've also got massive standard deviation. So there's huge risk. So what you ideally want is you want high return with low standard deviation. Like that's what you're looking for.
That is the holy grail. Someone who can outperform on the return or the performance side of things, but do so at a lower level of risk. So just remember, the thing about risk is it's always relative to something. So in this case, we make it relative to the S&P 500, which is obviously quite a widely used, well-known benchmark. So assuming one would be comfortable investing in the S&P 500, one would be comfortable investing in an active manager that tracks the S&P 500, but does so at a better return and a lower risk. So those are the points there. And yeah, Scott, you're quite right. Standard deviation is the kind of key measure of risk, numerically. All right, and then just on the bottom, again, another example, except in this case, we use the MSCI World as our benchmark, which I mentioned earlier, but that again is an exchange traded fund that tracks all the countries or all the shares in the world in the developed markets. And again, same scenario here. You see that the Schroders manager is able to generate a much higher return at a lower standard deviation or risk, leading to positive alpha numbers and a quite a large relative return of 42%. Again, on an already performing benchmark. So this MSCI World and S&P 500, I mean, this annualized 8.5 or an annualized 11% over 5 years is nothing to laugh about. Those are some seriously attractive returns. Alrighty, moving on to our next point. And again, this is a bit of a reiteration of what I've said, but this looks at one's personal outcomes and goals. Again, here I list short-term goals, long-term goals, or any defined outcomes other than retirement. And the point here is that those goals or requirements for the capital are going to be a very big driver of how the portfolio is constructed. I used the example earlier of buying a house versus saving for retirement. It's two completely different risk profiles because the timing is different. So we don't want to do anything. One doesn't want to go in anything overly risky if you know your time horizon is short, right? If you're saving for short-term goals. If you've got long-term goals that are typically longer than a market cycle of 5 to 7 years, then you're able to increase that risk profile a bit and target higher levels of return because you're not going to need to draw down on that capital anytime soon. So it decreases your risk of having to draw on capital during periods of volatility or market movements that are negative. So you're avoiding a scenario where you draw negative capital balances and you capitalize on losses on that capital if they are there. So that's an important factor just to keep in mind. Rather use low risk alternatives if you are saving for short-term goals, and then you can increase the risk profile as that goal gets longer or further away. And again, if you're saving for retirement and you've got more than 7 years, you can afford to add quite a bit of risk onto that portfolio when you constructed it. Our last topic, or our last slide, this just looks at the monitoring, measuring, and rebalancing of the portfolio over time. Fairly straightforward, but it's important to monitor your portfolio's performance relative to benchmarks on a quarterly and annual basis, just to make sure that everything's doing what it's meant to be doing. I would, if it's not on a quarterly basis, don't be scared to kind of push that to an annual basis. These portfolios obviously have different factors, and they behave differently in different market environments, but you're typically looking for that overall kind of trend over a couple of years. One needs to monitor the performance relative to the financial plan and the asset liability modeling. Again, this can be done at longer intervals due to market cycles, but important just to make sure that there is some kind of following of that roadmap. The reason why I say at longer intervals, because again, let's use 2022 as an example. Had you started your kind of planning or your journey at the beginning of 2022 and you went straight into a very poor year for returns in the listed market space, that typically works itself out over time, over an investment cycle of 5 to 7 years. So don't be too eager to change and mix things up just because 1 year you've been a little bit off the pace. As we all know, equity markets do not go up in a straight line. So you'll have negative years, you'll have positive years, but ultimately what you're looking for is that smooth kind of average over the longer term time frames. If you need to, over those longer term time frames, one will identify the changes in the ALM parameters and remodel this. So if things change, if capital value changes, if there's big changes to inflation or anything like that, you'll need to remodel this and just make sure that you kind of on track and everything is accurate. Otherwise you're going to get inaccurate numbers. And lastly, rebalance the portfolio if there have been any significant changes in the parameters, or if specific targets have been met. Reallocate to investments that offer greater upside potential. Again, fairly straightforward. If you've been in an asset class that's done exceptionally well, or an investment that's absolutely shot the lights out, don't be afraid to take profits and reallocate to investments that you believe are offering better value, that you can hopefully enjoy the same kind of upside from. You don't need to sit in something forever just because you feel that you don't want to make any changes. So don't be scared to rebalance the portfolio. Look for opportunity, spot the opportunity, and rebalance when need be. And that's it from me, Scott.
Awesome. Sorry, I couldn't find the unmute button there. I was like trying to find my mouse. Anthony, thanks so much. Do me a favor, just quickly before we wind up. Tell us just a little bit about Calio and how you work with the families. A lot of people come to me and they say, hey, I'd love to be able to try and, have someone that actually could help me do this, but not just put me in a box. And, there's that lovely testimonial that I've shared with everyone, and I highly recommend you go watch it, where, Cynthia came along. She was in Italy. So just to be clear, Anthony's mentioned South Africa. You don't have to be in South Africa. She was from American, worked out of Hong Kong, lives in Italy, and Calio has been helping her. And, one of the things that she loved was just the peace of mind. She met with you guys, you gave her the advice she'd been looking for. She'd had, I'm kind of putting words in her mouth here, but analysis paralysis for a whole long time. She hasn't known what to do. And you guys just sort of said, right. And you use fancy words like, I even need to look at it, ALM, asset liability monitoring. For us simple people, that's a plan. It's a plan to get from A to B. Okay, and what I think is so important here is that, yes, you guys have done it and are doing it for 60 of the wealthiest families, but you're also doing it for all the people that are part of the mastermind. And I think it's just giving people so much peace of mind to be able to go along and actually have someone that cares about them in a bespoke way, not just sticking them in a box. But tell us a little bit, just literally 30 seconds, a minute too. What is Calio and why do you guys, how do you do that? What's different from the high street solutions,
Yeah, so I mean, first and foremost, Calio is a global multi-family office, and kind of in the words there, global, talking to your point there, Scott, that we're able to kind of service clients in multiple jurisdictions, including
stop
the
sharing, dude, so we can actually see you better.
Sorry. So yeah, we're able to service clients globally, which is obviously a key benefit. I think another important factor is that everything that we've run through today in terms of asset allocation and asset classes and things like that, we're able to offer in-house. So we've got in-house stockbrokers, we've got private equity teams, we've got venture capital, we've got the family office, we've got the wealth planning divisions. So everything you saw today can be done in-house, nothing is outsourced. So that makes the process quite efficient, which is always something that you want. And I mean, in terms of the planning and the actual stages to it, take my presentation today as the kind of roadmap. It's about understanding the client, where they are, where they want to be, what retirement looks like for them, and how do we plan around that? How do we make sure that when we get there, we've done everything right, we've generated returns that are going to be able to sustain the client into retirement, and ultimately allow them to live a life that they want, as opposed to a life that they have to.
Yeah. No, look, I think that's brilliant. And I like what you said there with the 6 points as the roadmap. And just to remind everyone, 6 points, get clear on your time horizon. What is your risk tolerance? How do you do asset allocation? How do you diversify? What are your personal outcomes? And then monitoring, measuring, and rebalancing, so just to remind people that, sometimes these things, you hear standard deviation and you hear alpha, and literally people's brains just go, I have no idea what he's talking about. I'm scared. I'm not going to do anything. And actually, it's not that. Like, those 6 words make perfect sense. How long do you need time? How much risk are you prepared to take? What different assets are you going to put your money into? How are you going to diversify? Because you can't have all your eggs in one basket. What are the personal outcomes you want? I don't know. You want your kids to go to university, or you want to immigrate to a different country. And then finally, obviously, like anything in life, if you're flying an airplane from Sydney to London, the pilot keeps rebalancing like the direction, because you keep going off track and you have to keep going back so that you end up in London and not Moscow. So, that's all Anthony's actually saying. I want to be clear, to put it in simple English. But what I really appreciate, Anthony, is that you're keeping it simple for people, but the context and the substance actually is there, which is really important. And we've actually got Niels coming to join us just to talk about it, what it feels like for him from the other side of the fence, you know, to go through that journey. But just before we finish with you, Anthony, my last question to you, and I know a lot of people are going to ask, and I know you very kindly said you'll come back and join us in the VIP room, you know, for the VIPs to ask questions. There were some questions about bonds and other things, but in simple terms, high level, 1 minute, 2 minutes, what are you telling wealthy people at the moment that they should be looking at, thinking about over the next, I don't know, 6 months, 12 months, etc.? And again, not financial advice, just roughly, you know, where do you see the world going, you know?
Yeah, look, Scott, I think there's always two scenarios to that. It's does the person have cash? What does their investment exposure look like? Their existing exposure. So if someone's got cash, I would suggest getting a bit of exposure to markets. I would look for a diversified exposure across different styles and sectors. I wouldn't be taking overly bullish bets on any one specific style at the moment. As we kind of touched on last week in the market commentary for the month, there are certainly some risks around. I think everyone is probably familiar with the war in the Middle East. Russia and Ukraine are still at war, so there are definitely some risks. But I think we're in a scenario now where markets can potentially surprise to the upside based off the earnings that are coming out of the US at the moment. So make sure you have some exposure. Don't put all your eggs in one basket. Always a good idea to have some kind of alternative or private equity asset class there, just as again, it's not correlated to markets, so it typically does the opposite thing during times of market stress. So you can still deliver some good returns. And again, it's very client specific. If you're targeting income or things like that, make sure you have some good income options that are paying steady interests, things like that. They all help in the bigger scheme of things. But yeah, to summarize, get some exposure if you don't have any. If you do have a lot of exposure, make sure that exposure is in the right asset classes and there's no overly bullish bets in any one direction.
So did you enjoy that? Couple of questions that came through here. So Naval said, how does Mr. X start with 3 million capital savings? So, I mean, that would be what they have. Like when people come as part of our mastermind and they meet with the Calio team, it's what is their current portfolio. So it's what is their starting and tends to also include their family home. Then there were a couple of other questions here. There was one comment. Mikhail said, one important issue is that with age, you will spend less and your monthly cost of living will decrease. That's an interesting one. I'm not sure I agree with you. You know, what we find from most of our mastermind members is they actually want to travel more. They want to have more fun. So, you know, my sense is you would spend more and your cost of living would, yeah, including medical and everything, wouldn't necessarily go down. So I'm not sure I agree with that. But obviously each to their own. And then Mikhail, I'll share the presentation with anyone that's part of the Wealth Hackers WhatsApp group. So I'm going to literally put the Wealth Hackers WhatsApp group into the. Actually, Shane, would it be better to do the WhatsApp group or the Facebook group? Maybe the Facebook group, huh? Okay.
Yeah, you could do that.
I'll do the WhatsApp group. If you could just do the Facebook group into the chat room. And then what I'll do after the presentation is I'll go and put it up there, basically. I'll put the presentation up there, the PDF for everyone. So if you want to look at it close up. Okay. Okay, so you've got the link there to the WhatsApp and Shane will put it up. Then Mike said, in retirement, retirees do not need to buy special clothes for work or commute to work. I probably won't be making aggressive contributions, pensions, etc. But many retirees spend lump sums in their early years on newer cars, some home improvements, special holidays. So typically retirees can spend more in their first 10 years of retirement and then spend less in years 11 to 20 after retiring. If the retiree needs to go into residential care home, then expenses can go stratospherically for 3 to 5 years, but often longer for care residents with dementia. Yeah, so it's sort of in line with what I agree with you, Mike, in terms of the overall process. Okay, what I wanted to share with you now was, I love what Anthony shares, and a lot of people go, that's wonderful for super people that are super wealthy or whatever. And I want to share with you, I'm a big believer in real people, real stories. So I want to share with you Cynthia. And Cynthia is someone that has been part of our mastermind for nearly 18 months. She met with the Calio team. She's a teacher by background. And she actually, started earning a passive income within about 3 months. And I truly believe that her story can inspire others. So yeah, it's about, it's an interview I did with her so that people can truly understand what is possible. And my fundamental belief is, if Cynthia can do it, any of you can do it. What's going on here? Sorry, I switched off the wrong video. 2 seconds. So Cynthia, thanks so much for joining us. I deeply appreciate you jumping online. I was hoping for you to be there live next week, but you're off to Paris. So sounds like you've got an exciting trip organized.
More rugby, more rugby. Can never get enough.
Fantastic. So you've got a confusing accent for everybody. You've got an American accent, as I understand, did a huge amount of business in Hong Kong and now live in Italy. Tell us a little bit about yourself, just so the kind of people know who you are.
Yeah, I'm an American. I graduated from college and spent 10 years in New York City in the advertising profession. And during that time, I kept putting on a backpack and leaving and traveling around a part of the world and putting on a backpack and leaving. And the third time I did that, I backpacked around Asia and ended up in Hong Kong permanently, ironically, to watch the Rugby Sevens. And I rolled into town to watch the Rugby Sevens, and I stayed 10 years. And during that time, I worked in marketing in China. So I continued my profession. And relevant to this conversation, I took my first year's salary almost, because I was running around with backpacking money, $100 there, $100 here. I took my first year's salary and just banked it into what I thought was a mutual fund. It was something all the expats were doing. And then I just left it for 25 years. And I worked in Hong Kong, and I met my husband and had 3 kids, and we didn't want to raise them in Asia. And we decided to move to Italy. He was English, I was American. We decided to move to Italy, got to Italy, and started renovating a big house. That was a big money sink, and went into olive oil picking, olive oil making. So farming, that's a big money sink, as all the farmers in our mastermind know. And so I ended up here separated from my husband, with not having worked for 15 years, because I'd been a stay-at-home mom and an olive oil farmer. And that's how I ended up. That's how I ended up finding you all. I think I took Scott I took an online course. It wasn't even an online course. It was one of those Jeff Hayes film productions, like Money Matters or something. It was just money
Revealed by Jeff Hayes.
Yeah, Money Revealed. And I met you on that, or I listened to your speech on it, about how property was the last bastion of the wealthy, and that's sort of one thing that the average person doesn't get into. To get into property back then, 20 years ago, you needed to have a lot of money. And you talked about how you wanted to make people with $100, $1,000, eventually, $10, be able to get into that. And it always stuck. And I didn't see or hear from you again for 5 years. And then I think Wealth Migrate came up on my radar, probably some social media radar. And I jumped on it. And that's how I found you all again.
And what sort of challenges were you facing at the time? Like, what problems and challenges? We all, there's a great thing that we move 5 times more away from our problems than we do towards our pleasures. So we tend to take action because of problems, not pleasures. So what were the problems or challenges you were facing?
Yeah, the problem was huge. The problem was I'm living in a foreign country. I can't go back into my old career, which was China media, because I'm living in Italy. I had 3 kids to feed. I'd left my husband. And I was like, where's my skill set? So I was actually at the stage of like, just how do you put food on the table? And I, found a place to live, suddenly had 5 income streams, and all 5 of those income streams dried up during COVID. And it was the first time it hit me that I was working for money, working, selling my time for my hours for time, and that my money wasn't working for me. And COVID and that incident and that realization happened at the same time that 20-year fund came to maturity, and I suddenly had a chunk of cash. It wasn't a lot of cash by any means, but you got to start with what you start with. And I was in that frozen position of like, what do I do with it? Like, I need this money to work for me because I'm over here scrambling to find a job and to put food on the table for the kids. And I didn't have any debt. I was fortunate. I owned my own home. I owned my car. I didn't have any credit card debt or anything. So in that way I was lucky, but I was really at that paralyzed, what do I do? What do I invest in? I've read enough, read The Motley Fool every week for 30 years. I thought I was relatively financially literate, but I was frozen. I was just like, what do I do with it? Because No, I was just saying, it was just at that age, where my kids are 20, they can make fiscal mistakes. And I was at that age where I felt like I don't have another, ride it out 20 years and the stock market always rebounds. I don't have another 20 years to ride it out. Like I had to do that's what my fear was.
A lot of people talk about wealth protection, and that's what I'm hearing. It's one thing to grow your capital, but you also want to protect the capital you've worked, so hard to create over the years. Why did you choose to work with us? What was it that attracted you?
I mean, I had finally found people that were exactly like me, like from multiple parts of the world, maybe dealing in multiple currencies. We have, some gentlemen in the mastermind that might be South Africans. They're living out in New Zealand. They, the typical, the old fashioned 5 flags, you live in one country, you earn money in another, you've got a bank account in a third, you pay taxes in a fourth. And it doesn't really exist anymore, but it was very hard to find, like-minded people who understood different parts of the world and who naturally understood diversification. And the mastermind narrowed that down and made it even more specific, diversifying across time and currencies and assets, is even more focused. But just the general idea of diversification. I mean, all my European friends just invest in European things, and all my American friends just invest in US things. And a lot of my Hong Kong Chinese friends are heavily invested in China and the BRICS economies. So I really liked that. And then I liked the overall philosophy that we were trying to make what's available to the 1% available to the average person. And that really resonated with me, because no matter how much you learn, you're always thinking, what's that little bit I don't know? What's that part of the puzzle I don't know because I'm not, a high net worth individual.
So tell me, in terms of, you took a leap of faith. We've all done this, where it's like your sort of intuition's telling you to do something, but there's a cost involved, and you're like, I don't know if this is going to work for me. And what's been your experience? I mean, we've been on a journey now for the best part of nearly 12 months, actually. And what's been your experience, being part of this diversification mastermind?
This diversification mastermind was different from every other sort of course or challenge or, I don't know, group I've ever joined, because it took you from the philosophy of how you're supposed to be investing and actually provided us with answers. So it took us from, it's not just, I didn't need the mindset stuff anymore. I felt like I was already there. And it took us from the mindset right to like, well, here's some ideas that you can invest in, and let's all jump into this together. And if you're not going to invest in what we're providing, here's some other experts in different asset classes who you can go buy a promissory note from, or go buy an EFT from, or go talk to someone in a private, what do they call it? The family management, family asset. What are they called? Yeah. So you provided us, you weren't trying to be all things to all people. It was like, I'm Scott, I'm the property guy, this is what I know. And I'm never going to try and sell you a commodity. And I'm never going to try and sell you stocks and bonds, because that's not what we focus on here. But if you want those things, here are those experts that we're bringing into play as well. So I liked it that it was, it was holistic. Everybody sort of knows what they know, and that we draw on the experts in each related field for people to either choose to work with or not. But so you got that learning curve, but you also got that ability to to execute and make investments with where you want them.
I think what you just said there is so important. It's the execution. At the end of the day, we got to get results. And, there's absolutely no point in getting more knowledge. And, it's that whole saying of people think knowledge is power. And it's rubbish. Applied knowledge is power. So, one of the things I love about your story is that, you've gone and met with Callio. So, again, I would have talked quite a lot about Callio already, but, most people don't get access to a family office. A family office is literally for the super wealthy. They manage $600 million, only 60 families, but through an alignment of interests, actually. So they believe in, helping everybody get access to the same information, the same opportunities. And because of that, they agreed to exclusively work with the mastermind. And because of that, you and I have got access to their skill sets. Talk us through your experience with Callio, because it's been an interesting one to get your feedback.
Callio is phenomenal. You have a half an hour free Zoom meeting with them, and with the president in the room, not just someone who's going to execute. And they say, "What's your story? What are your needs? What's your financial situation?" And I pulled up that matured fund that I had and said, I need to invest this, but I can't invest it for the long term. Here are my needs. I have immediate goals. I have 3 children that have just gone off to college. So I suddenly have immediate financial goals that I'm not going to be able to meet if I keep just relying on my income or selling time for money. And they listened. They asked really smart, relevant questions I wouldn't have thought of, but they were particular to me. And I didn't feel like I was being put into a box of, you're this type of investor, or you're this type of investor, or you're this type, And it wasn't just the are you high risk? Are you low risk? It was really they really tried to understand my needs. And within 24 hours, they had a proposal to me that said, here's what we're going to do to get you money right now. And then here's what we're going to hold off on and keep discussing and think about and get you into eventually. But here's what we're going to do to solve your immediate problem. And within 1 month, I had income coming in from an investment from them, which just liberated me. I mean, it was just the buffer I needed to not panic about money anymore and to make the rest of the decisions slowly and, from a different mindset.
It's so interesting what you're talking about there, because the most of us just go along, we meet a financial planner, they put us in a box, we stick our money into something we don't even know what it is, and we don't get paid an income. We get promises of long-term retirement, but we don't get an income. And what you just said there is within 1 month you got income back in your pocket. Now, in my belief, income is freedom. So and I mean, I know for you don't need to go into the personal story, but even then, I mean, it had a dramatic change for you in quite a quick space of time to give you that peace of mind.
A huge space of time. I mean, I'm an online English teacher. The year after COVID, the Chinese government banned all English teaching online. And I went from a 7-day-a-week job to nothing, to zero. And it was, and given that it's China and China's unpredictable, there's always those undercurrents and those rumors among online teachers. They're going to do it again. They're going to do it again. But having that financial buffer means to me that if it happens again and China locks out all online teachers, I'm not going to be sitting here with zero income. I mean, it's a safety net that's just unbelievable to me, that someone who is not by any means a high net worth individual can have your money working for you, can have my money working for me, and give me that peace of mind.
Yeah. So tell me, 12 months ago, you could have been like so many other people. And again, thousands, I don't even know, hundreds of thousands of people have watched me present over the last 20 years. Most of them sort of hear it and don't do anything. 12 months ago, you heard it, took action. If you hadn't have taken action, how would the last 12 months have been in your mind? Like, what would have been the difference?
I can definitely tell you I would still be sitting there with that matured mutual fund in the bank account or pension fund doing absolutely nothing, because it matured 2 years before or a year before I met you all. And I was like, right, get this invested. This was, it was the #1 goal every month. Get this invested in doing something. And I just didn't know what to do. I had so many ideas and so much information coming from me. And that's where I was 1 year ago. And, within 2 months of starting the mastermind and, 2 weeks of meeting Callio, that money was invested and working for me. And I honestly believe that if I hadn't found you all, I'd still be sitting on it. It would still be doing nothing. It would still be sitting in a bank account waiting to be invested.
Yeah, no, that's brilliant. Or maybe worse, given to a financial planner being eaten away by fleas. You know what I mean?
To lose more money over 20 years, right?
Yeah, exactly.
Yeah.
Tell me, why is this different? You know, there's lots of masterminds out there. I mean, there's a plethora of information on the internet. Why has this been different for you from, you know, your other previous experiences?
Yeah, the fact that our philosophy is we're all going in the same direction is wonderful. But I think you know, certain segments of our life, and you know, when you go into that initial conversation with all of us masterminders, you know, you're breaking down what are our personal life goals, what are our financial goals. You know, life is more than just finance, but finance is one of those highly emotional, you know, people have a hard time talking about it. You know, it's not polite to talk about money. Maybe we don't discuss it with our best friends, but the mastermind is that one place I can go to where we're all talking about money. It's allowed. It's, you know, it's the purpose of it, and it's that space where we all throw out our, you know, our mistakes. You know, you've shared with us, you know, I tried this and this, you know, this is what happened to this property and this didn't work. We all can throw out our situations, and we're just all in the same space. We're all in that. Let's talk about money. Let's learn as much as we can, and you know, what are the next steps? What are we going to execute for each other? And it's just such a nice space to be in, because you can go out in life and maybe not even talk to your spouse or your best friends or your brother or your kids or your, you know, about money. And it's just that space, because it's such an important part of our lives. And it's that space where we all have permission to do that. And we're all going in the same direction.
Yeah, no, I love what you said. And I think, you know, there's so much power in collaboration, you know, and you know, again, just simple metaphor, birds flying in a flock can go 70% further.
Yeah.
You know? So
Yeah.
unfortunately, I know that, I don't know if you were the same, but certainly myself, I was trying to do it all on my own for 14 years.
Yeah.
Like, this was like, you know, I'm getting nowhere doing this strategy.
Right.
Tell me last thing, if someone's sitting in you know, they're sitting here, they're watching this and they're sort of saying, it sounds too good to be true. I don't know, like, what should I do with my life? Have you got any advice like to them? You know, you've been in that situation. What would be your, you know, advice, recommendation? We don't get financial advice.
I think the problem is that if you've made it this far in either the Wealth Migrate platform or the Wealth University you've done, you're already an intelligent person, and that almost works against us, because we go like, I'm smart, I can do this, but oh my God, EFTs. All I have to do is Google like top 10 EFTs, or, you know, jump onto one of those crowdsourcing, you know, platforms. So I can do this by myself. And I think it's almost a hindrance being somewhat financially knowledgeable. I mean, it's almost a block, because you get to that. Yeah. I've taken the course. I've done a challenge. I can figure it out from here. But there really isn't anything like finding the partnerships that we have in this group. I mean, there is no way, for all of my love of reading financial, you know, documents and being on financial websites and blogs, there isn't any way I would have ever found the partners to invest with and to invest in without being in this group. There's just no physical way I could have ever, you know, industrial buildings in Texas, or, you know, healthcare centers in Brisbane. How am I going to find those sitting here in you know, in the middle of Europe? So yeah, I think the partnership is the number one reason to join the mastermind. It's not just about the knowledge, it's about how do you execute, but you can't execute unless you have the deals in front of you. And you can't have deals in life, in any aspect of life, unless you have good partners. And it's a partnership that I would highly recommend people to, you know, it's worth the entire investment. Yeah. Is the partnerships abroad.
Well, thank you so much for your time now. Thank you for sharing. Right. And you know, for me, the thing that I'm most grateful for with the mastermind is the amazing community that we've got. And you know, you're one of the stalwarts that are leading that community with your energy and everything, which I deeply appreciate. And I love, you know, what I love most about your story is that most people assume that everyone's like, you know, uber wealthy and got millions of dollars and, you know, highly sophisticated and whatever. And we're not. You and me are not like that, you know, and yet we can get access to the same knowledge and the same partners. And the thing I love most about when you shared with me your story, it was like, well, look, I've listened, I've acted, and look at what it's given me, and in quite a short space of time. And I think I just deeply appreciate you sharing that with people, because hopefully it can inspire others to get the results for themselves.
Yep. I would say jump. I mean, I can't, when I think of where I was 1 year ago, it's a million miles away. And not just because I have income coming in, but knowing what my next steps are. Like, I know where I'm going. I know where the next chunk of money is going to go into. I know what, I want to invest in. I know what I don't want to invest in. And I know the partners that I want to do it with. And that's just a huge weight off anybody's, financial shoulders.
Awesome. Well, we look forward to further results from you. Thanks so much.
Good. Thanks,
Yeah.
Scott.
Then. So I hope you enjoyed that. Three interviews, one from Garth Wallman about a family office and what's it all about, Anthony on the 6 pillars, and then, Cynthia in terms of someone who's actually gone and done it. Now, just quickly, a couple of questions. Naval said, what does Calio charge for their services? Naval, for people that are part of the mastermind, it's actually free to set up. And then they generally work on an assets under management fee for the assets they do manage, and it tends to be in the region of about 1%, but there's no additional costs in terms of the overall process. But yeah, people need to join the mastermind to be able to get access to their services. Then Sandra said, what is the possibility of entering this type of market at a ripe old age with limited resources other than the explanations being given? Sandra, yeah, look, it's a tough one. I'm not here, or no one here is here to give financial advice. It's very difficult to get bespoke and to give advice in terms of without more detail. I do believe in, again, what we do at the challenge and at the investor roadmap. Maybe Shane, if you just want to share with Sandra when the next investor roadmap is, because our wealth plan and stuff like that becomes important in terms of an overall plan, in terms of what you're looking at. Okay, so hopefully that helps both of you in terms of just some questions that you asked. Okay, let's look to wrap up tonight in terms of the overall process. I do want to just share with you, one of the things that Cynthia said, thank God for this mastermind, the partners it brings us, and the exponential learning curve that it has gifted us. I just want to kind of share with you and kind of finish off. Often people feel overwhelmed. This is an overwhelming space. I've always, people always kind of say to me, Scott, when I hear all this and I learn from Anthony and whatever, I've learned so much from Anthony in the last 18 months. It's been phenomenal. But sometimes it can feel overwhelming. It's like drinking from a fire hose. And I'm going to kind of do a Q&A if anyone wants to do a Q&A. But just for those who want to be on a similar journey to Cynthia and myself and about 60 other incredible people from around the world, men and women. We've got people from England, Italy, Spain, Portugal, America, Australia, New Zealand, South Africa, Zambia, and Swaziland. I think that's everywhere. I'm not sure if I'm missing somewhere. I think, but yeah, it's basically being created, the mastermind, for people just like Jordan or Victoria. And I tend to ask people, I'd say to them, right, could I ask you an extremely direct question? And just imagine, it's a hypothetical thing, but just imagine you had a serious medical condition and you had to lose 10 to 15 kilos quickly. Now, again, I hope this never happens, but I want to make a point. And so if your doctor said you had to lose 10 to 15 kilos and it was an absolute must, not a maybe, not I should do it, it's an absolute must. But you've got two options. You can go home and you can do a home study course, or you can have a coach. Literally turn up on your door, knock on your door every morning. Which one would you choose to be able to get better results? Again, be honest with yourself. Put it in the chat box, please. Would you do the home study course if it was an absolute must, or would you get a coach? Let me know what you're thinking. So, yeah, get a coach every time. I mean, I think we could all agree it definitely would be the coach. And the same is true for your wealth. Imagine if you had to build globally diversified passive income. And so, you've really got two options. Again, for investors, those that are super experienced, sophisticated, confident, or motivated beyond belief, we've got just what the doctor ordered. We've literally got 2 home study courses, one that deals with the right information and one that deals with the right partners. So we've created Wealth Going Global to give you the right information, and we've created Asset Mastery to give you access to the right partners. We've proven for over 2 decades that it works, And yet what we found is that people needed a far more effective option. They actually wanted a coach. They wanted someone to hold their hand and come on, the journey with them to create the wealth system and a portfolio. And what we found is that most people want that one-to-one support, that coaching, but at a lower cost. And so we were constantly exploring how to do this. And again, as you probably know, if you followed anything that I like to do, it comes down to technology. Just like Uber changed the taxi industry, Airbnb, the hotels, Netflix, the blockbusters. We basically spent 20 years in the space. I love personal development. I've done a lot of coaching programs, a lot of masterminds. And we also looked at thousands of our investors and we said, right, what can we do to help them? Because in our opinion, the investment space is actually broken. And so we fixed it. We created the 2 home study courses, Wealth Going Global to give you the right information and Asset Mastery to give you the right partners. And then according to Harvard, you'll be 400% better off. So 4 times better off if you actually have a coach. And then I found, I found this video recently because I've been part of Mastermind since 2011. And I found them just to have the most profound effect to help me get results. And I found this little video which explained why.
Now, this is extremely predictable. Tons of research around it. Humans change 5 times faster in groups than they do with a one-on-one coach, consultant, or therapist in that case.
Wow.
So I started looking back at business models and people who had done this effectively over the generations. Masterminds aren't new, folks. They're not new at all. People have been doing this for thousands of years. And when you put a collection of people together who are all committed, all driven, and all so want to make the right changes happen, and you give them a leader to follow who's willing to get in the trenches with them, all of a sudden you start finding real, rapid life or business transformation.
So what does he say there? You can actually do it 5 times faster in a group than you can with a one-to-one coach. So one-to-one coach, you're 4 times better off. And in a mastermind, you're 5 times better off than if you had a coach. So in my maths, 4 times 5 is 20. You're 20 times better off than trying to do it all on your own. But you've got to be with a collection of people who are all committed, all driven, and so want to make the right changes happen. And give them a leader to follow who's willing to get in the trenches with them. All of a sudden, you start to see real rapid life and business transformation. And so the question I have for people always is, this is your comfort zone. And if you want to leave your comfort zone, if you want to go to being a global citizen, to globally diversified passive income, to generational wealth, to working with a family office, to building your legacy, this is where the magic happens, but it's outside your comfort zone. And one of the things that I believe I was put on this planet to do is to help people, go to where the magic is, to get out of their comfort zone. And that's why we created the mastermind. It really was an evolution on our buyers trips that we started over 12 years ago. And in simple terms, the idea is to build globally diversified passive income, to diversify across countries, currencies, assets, partners, and time. And there's 5 simple steps. The first step is that you and I sit down and we get very clear on your top 3 outcomes. Most people have it in their head, but they never actually take the time to write down what are their top 3 outcomes, what are their top 3 measures. Then you sit down with Calio and you get very clear on your starting point. What is your tax? What is your structuring? How do you optimize your current portfolio? Then it's about building a plan to get from where you want to be and where you are, and to get a plan to get from A to B. Then it's the monthly execution. This is what we literally have tomorrow. It's the accountability, it's the mindset, and the execution. Most people know, most successful people know that you need accountability to get ongoing and regular results. And then finally, it's the investment. And that's where you're learning all of the investment terminology, getting access to the deals, investing. 5 simple steps that happen over a year to get significant momentum for you. You get access to Wealth Going Global, which will help you, know about the top 5 countries to invest, the top 5 currencies, the top 15 assets, how to find the right partners and avoid 80% of the mistakes, how to build a portfolio over time. You'll get access to Asset Mastery, so that's all included as well. And so you've got access to the right information and the right partners. Now, we had 2 choices. We could go with the expensive option, or we could go with the more affordable option where more people could get access to it. Now, I've spent $50,000 to be part of Tony Robbins' mastermind. we can easily charge 50, but we don't want to do that because we want to make sure that we're leaving meat on the bone so that people can actually invest in deals and earn globally diversified passive income. At the end of the day, we're here to help you get results. A standard in England and Europe and America is at least 25,000 for a mastermind. And again, for the same philosophy, we're not charging that. Even $10,000 is kind of a no-brainer in terms of a mastermind. And although we are moving to this in the near future, we're not charging that at the moment. But I do say to people, I'm not going to charge you $10,000. But even if I was to charge you $10,000, would it be worth it to you if it helped you achieve your freedom goal? Yes or no? Just type in the chat box. Yes or no, please. In fact, if I did all of this and provide you with peace of mind for you and your family, and you knew that your family was secure, would it be worth $10,000? Yes or no? What about if it helped you protect your wealth? Would it be worth $10,000 to you? What about if it saved you a decade of your time? Would it be worth $10,000 to you? And finally, what about if it did all of this and provided you with globally diversified passive income and thus the peace of mind? Would it be worth $10,000 to you? And it reminds me of a story, and I've told this story many times before, but with Michael Honeysett. He came on a buyer's trip in February 2013. And, we were going over to buy houses in America that were $80, $90, $100,000 plus. You needed that in cash. And the buyer's trip at the time cost $2,000 to come over. And Michael was like, oh, I don't really have $2,000. Can we negotiate? And I remember thinking, I should tell him to walk, a long walk off a short plank. But I didn't do it. And him and I became very good friends. And when I joined, it was the best money I ever spent. And would never have happened if I tried to do it myself. And he's literally achieved his objective. He wanted to create globally diversified passive income so that his daughters could live anywhere they want, study anywhere they want, work anywhere they want. They've done that. And the whole family immigrated to England based on their 10-year journey. And it made me reflect a lot because it's about making it affordable up front. Now, you've got to get the right type of people. Our goal is to help people create at least $5,000 in passive income, to do it 5 times quicker, simpler, and safer than trying to do it on your own. And Michael reminded me that, keep it as affordable as possible, because our real aim here is to build partnerships with people that want to invest. The challenge is we do have constraints because we're working one-to-one. I'm working one-to-one with you. Alex is working one-to-one with you. Callio is working one-to-one with you. And so we can only onboard 5 people at any one time. And so how do you apply? You literally go to diversificationmastermind.com. It's an application call. It takes about 30 minutes. It's very simple. We're trying to understand what it is you're trying to achieve. We're wanting to identify the risks. We're also wanting to see if you qualify in terms of the overall process. And equally, from your perspective, it's so that you can get a better understanding of the mastermind and make sure there's a mutual fit. There's 3 things that are prerequisites to a successful mastermind. The first is that you've got a group of like-minded people. So Alex and I take a huge amount of energy in curating and making sure that the right type of people are joining the mastermind. The second is that there's a common purpose. So if effectively ours is globally diversified passive income, and we want to make sure that everyone that's part of it is pulling in the same direction. And third, as you know, is that you've got a leader that's prepared to jump in the trenches and kind of do what it takes to help you get results, whether it's the carrot or the stick. And that's certainly mine and Alex's objective, in this process. So that's the application call. If you do book a call, my request is please make sure that you turn up on time. Your time is valuable, so is Alex and my time in terms of that process. And then, as I said to you, there are only 5 spaces. So if it is something of interest to you, literally, go and book a call. And we just had the challenge last week, so we are pretty full already. But we already had this webinar set up. And we just wanted to make sure that we were delivering value in terms of the overall process. If you want to go and see, what are the returns that people have achieved from coaching, it's 344% from coaching and over 700% return on investment from coaching. And then if you want to go and see what clients have got to say, there's a lot of feedback. You saw Cynthia tonight, and there's plenty of others that we could share with you, both written and video testimonials. In terms of a guaranteed satisfaction, this one's an interesting one. I can't guarantee you results because ultimately this is going to be up to you, but I can guarantee you we'll do what it takes, whether it's the carrot or stick, to help you get the results. And in terms of return on investment, I had a gentleman actually ask me, he had $12,000 to invest, and he said, oh, would it be worth it? And I actually showed him that, whether it's $12,000 up front or $1,000 a month, and he invested $5,000, his return on investment would be 254%, or effectively in today's money, $12,000. So you invest $5,000 to make $12,000 in today's money. It's a bit of a no-brainer over 5 years. Over 10 years, it's $50,000 plus, and over 30 years, it becomes really a large amount of money. And this is the difference between having the right information and the right partners and building a cohesive portfolio over time. So if you are interested, literally go along and, as I said, go to diversificationmastermind.com. This is what one of the ladies that I did the step one coaching call with, where effectively we get very clear on the outcomes. A couple of months ago, this is what she had to say.
Hi, Scott. This is just a quick fan message. Just wanted to thank you again for our coaching call the other day. And then also wanted to thank you for the brilliant idea of that, sort of publicly putting in your goals in that Google Sheet. I see that the Google Sheet magically populated itself since the first time I saw it. And I must say the 2024 goals are very inspiring. And it's amazing to see. I found it incredibly supportive to see, people's just the amount of energy and the goals, and it's really inspiring. So just wanted to thank you for that. I really enjoyed reading everybody's goals. I haven't read all of them, but and somehow it's just really helpful. All right, well, have a fantastic day, and we'll see you in February. Bye.
It's all about the power of community. Step two is looking at your current portfolio. We had, we got investors from all over the place, but this gentleman is an electrician in England, and he had a number of properties. Some were cash flow positive, some weren't. And, the one thing about a coach is it's about being a mirror and helping make decisions. I have it all the time with people in South Africa, particularly in Gauteng. Do I keep my properties? Do I sell them? Do I remortgage my properties? What do I do in terms of portfolio analysis? Then it's also about looking at your portfolio construction and, optimizing your current portfolio, your tax and your structuring and everything that Calio do. And, as an example, this mastermind member said, it's far better to have it all under one roof, all your different asset classes, because they, had so much overlap and so much complexity, and to bring it all into one place just made complete sense for them in terms of the process. So simplifying our admin, our tax, and our structures has made it so much easier. So, if it is something that interests you, and again, you want to learn, as Neil said, I must say, listening to all the Zoom meetings has made a huge difference in understanding investment options. I don't feel stupid anymore when having discussions with the likes of Calio and others. Of course, I don't know enough, but at least I can follow their opinions, comments without being completely in the dark. It is so liberating. And many others, mind-blowing, very valuable, extremely enlightening. This perspective is very valuable. We've seen Cynthia's, Abdul is another gentleman, this gentleman's 72 years old. I mean, he's an auditor. So, we had highly sophisticated accountants, auditors, business people, investors. We've had teachers, we've had farmers, electricians, so all different walks of life. But Abdul's got an amazing story as well, as to why, he's a very sophisticated investor in South Africa, but he wanted to be a global citizen and diversify. Why do we believe you should work with us? Well, there's many, many different reasons why people don't. But often I say it's because they don't believe, they don't have the time, they don't have the money, or they don't have the knowledge. In terms of the time, the mastermind is specifically being created for people that are time poor. So, it'll take you no more than 3 to 4 hours a month. And, I always say to someone, if you don't have 3 to 4 hours a month, I guarantee you nothing's going to change in 10 years. I don't have the knowledge. Well, we're giving you access to some of the best partners in the world. You don't need to know everything, but you can get access to partners. You can decide if you know, like, and trust them. And then you can actually partner directly with them. And from a money perspective, it's, one of the most affordable options to be able to do this global diversification, to deal with a family office and have someone actually hold your hand to create your own bespoke solution. The last reason that we believe you should work with us is, to my knowledge, we're the only one that does global diversification. Everyone else will kind of put you in a box, be it structured notes, be it medical office, be it houses in London, whatever. Whereas we're the only ones that actually do global diversification. And a couple of things to finish off. I'm not telling you anything I haven't done myself. I've spent $15,000 a year to be part of Singularity University, $25,000 to be part of Roger Hamilton. I actually did that for over 10 years. Maverick, $1,000, over $40,000. That's how I got to spend time with Richard Branson on Necker Island. And $50,000 where I was part of Tony Robbins' business mastery. So why not join over 4,000 other investors, whether it's wealth protection, plan B, peace of mind, diversification, freedom, global citizen, empowering your children, immigration, or ultimately living a life unlimited. This is the formula. You get to decide if you want to do it all yourself. It's about building globally diversified passive income, diversifying across countries, currencies, assets, partners, and time. And if you want to do it as part of the mastermind, you get the bonuses of having priority access to me and the team, access to tax and currency partners, asset class mastery, wealth going global, Clem Sunter masterclass, 12 months of the wealth hacker, access to the best immigration agents, access to the wealth weekends, first access to the buyers trips, and finally a bit of tough love, which is interesting because we've had this. We've had a number of people that like, oh God, and I talk to my husband, my wife, my financial advisor, etc. Now, by the way, I highly recommend talking to your husband and wife. But often when people go to their friends and family, it's an excuse for not following through on their dreams and pursuing their goals. And this is a huge mistake. It's something that can haunt you for the rest of your life. I have it all the time. People come to me and go, oh, Scott, I saw you 10 years ago. I wish I'd done something. And this is because you rely on other people's approval. Even though those who love you and care about you most, you will always be the slave to their emotions and what they think, feel, and believe about you and your potential. And their belief about your potential is almost always a reflection of what they think, feel, and believe about themselves and their own potential. 99% of the population is extremely limited. And this may or may not apply to you, so proceed with caution. But of course, your friends and family don't believe in you. You have no track record of success, and they start, you start late and end early. You whine, complain, and make excuses. You don't finish when you start. You talk the talk, but don't walk the walk. And so this is why they want you to be safe. Lower your expectations, fit in, conform, and do what everyone else is doing. But as you already know, this is not the way to live an exceptional life. The only solution then is to drastically change your actions, prove them wrong, say what you're going to do, and then do it. Get up, take action, massive, imperfect action. This is your life. Nobody's coming to save you. And you got this. So anyway, it's just something that Shane shared with me, because often people doubt themselves. And I'm a big believer in, I was talking to, I know Mike's online, Mike and I were talking about this last night. I'm a big believer in your intuition. And at the end of the day, the mastermind is right for certain people and it's not right for other people. And that's why we sit down and we have a one-to-one chat with people, because our goal is to help people get results. That's why we're here. But don't hold yourself back. Don't come up with excuses that's going to hold yourself back if this is, something that's right for you. And like I said to you, it's not right for everything. And as James Painter said, you've got to have the right information and the timing. A lot of people think more information equals better results, but it's rubbish. Rubbish in, rubbish out. Multiple opinions creates confusion and indecision. Information after the fact doesn't help. You can get the long-term trend right now, and you can still lose money through buying and selling at the wrong time. So, having the right information on the right partners is absolutely critical. And so, in conclusion, if it's something of interest to you, go to diversificationmastermind.com and book a call with Alex or myself. We'll take you through that process. If you're not sure and you want to kind of use the navigator, then I'd highly recommend that you just go to the link and use the navigator, and it'll help you in terms of the next steps of what to do next. If you want to come along to our challenge, our next one's at the end of July. So it's actually a 5-day challenge in terms of the overall process. And then don't forget about the webinar next week, which is the psychology of money, all about the Enneagram and wealth and marrying it all together, that to my knowledge, I've never seen done before. And so in conclusion, if you want to go fast, go alone. If you want to go far, go together. It's an African proverb. And so thank you to all of you. I hope you enjoyed tonight. I know it's a lot of information in terms of, you know, what Garth had to share, what Anthony had to share, and even what Cynthia had to share. But I will stay here just in terms of if anyone's got any questions, because I know we've covered a lot. Yeah, happy to help. Is there anything else that I can help with? Any questions that I've got? Anything that hasn't been answered in terms of people? You know, one of the things that I've already mentioned tonight that I'm truly, truly grateful for is the caliber of the community we've got within the mastermind. Like, I get to learn and collaborate with amazing people. And, you know, just tomorrow, we've got our mastermind session where I'll be learning from Anthony again, what's happening in the markets, where are they going, what do I need to know? You know, we've got the Enneagram and Wealth tomorrow. And it's just one of the greatest gifts I've been given to be part of this. And, you know, every month I'm learning so much myself, even though I'm facilitating it. But that's the beauty of a mastermind. It's not about one person. It's about the collective group working together. Mikhail, are you asking, you invest in properties? Completely. So we invest in the alternative assets. So properties, structured notes, private debt. There's actually 15 different asset classes that we look at. We've just done crypto. We did a consortium, a group of us did a crypto investment. We've done gold. We've literally been through all the different asset classes. Recently did venture capital. So it's not only about learning about all the asset classes, but it's also being able to participate in those asset classes. Where do we invest in properties? England, Australia, America, and Europe. We've currently got 2 deals, one in Phoenix in America and one in Germany. We've got another one coming up in Austin in Texas, and we've got a London opportunity coming up. So yeah, we don't have anything in Spain at the moment. It's for us, the key thing is about the partner, the quality of the partner. And there's quite a lot that I'll go into that. I have done investments in Spain, but it's all about the fundamentals, primarily commercial property, not residential. And so for us, it's critically important that we've got the right information and the right partners. Yeah, Jay, it's lovely to have you here. I'm going to ask you to do one of the presentations soon because you've seen me lots, and I'm sure you can do as good a job. Perfect. Yeah, Mikhail, sorry, I hope I'm pronouncing your name right. Yeah, happy to talk tomorrow in terms of the different options, and we can take it through in terms of what your needs are and whether we'll be able to help you. Michael, okay. Excellent, Michael. Thanks for letting me know. Okay, anything else that I can help with for anyone else? I need to go and prepare for a mastermind tomorrow morning. We get going at 8 o'clock tomorrow morning. Okay, Shane, anything from your side that I've forgotten?
Nope, I think you've covered everything. Thanks, Scott.
Excellent. Okay, well, thanks very much, Shane. Thanks to everyone. And I highly recommend that you join us next week with the Enneagram of Wealth. Like I said to you, I've never seen it before from anyone. I know the Enneagram is very popular around the world, but I've never seen Enneagram and Wealth married together. So I think it'll be very, very enlightening for you in terms of this journey. So yeah, see you online. Cheers, everyone.